Hi, I'm Keith McCullough, and welcome back. Thanks for joining us. This is our second slot and first time on Hedgeye TV. I'm really looking forward to having this conversation with you, Ayesha Tariq, and I did mispronounce her name coming into the last one, so my first big mistake of the day. Apologies for that, but thanks for joining me. I appreciate it.
It's such a thrill to be on, Keith. Honestly, I mean, I was just telling you, I've watched Hedgeye for 3-4 years now. I've followed your work very closely. The team is absolutely brilliant. I think you have the best research out there.
Wow, that's we did not pay her to say that, by the way, and she's live from Dubai. I do appreciate that, and I also appreciate the authenticity that you bring to. I call it the game, of course, but I mean, just how many people? Let's just start with this, and I just had a real conversation with Mama Bear herself, Stephanie Pomboy. But your Twitter handle, the first word says that you're a mother. I mean. There's so much out there these days, people that are anonymous, people with snark, people I would never engage with that on Twitter, of course, myself. But I think that's really cool, like how you came to this business really, and to having this conversation with me. Can you take us a step back for people that are not familiar with your background, like how you came to be?
Sure. So I'm a mother, of course, and that's my most important job. Let me put it frankly.
Awesome.
But I started out in corporate banking with Standard Chartered, and even though I've left banking now, I still think of myself as a banker, and it was a fantastic role. I think I learned a lot because the best part of corporate banking is that you deal with companies from different industries, but you deal with the insiders, right? So it's not like analysts out there who are dealing with the outsiders and you get fed what you want to hear. We are closer to the CFOs, and they need to tell us their dirty little secrets if they want money from us, right? So it's an interesting job, and there's a fine line between what they want to tell us and what we want to know, right? So I think I bridged that gap pretty well by trying to form relationships versus actually just getting in there, making the sale and getting out. So I learned a lot from that job, obviously. And then I moved on. In fact, one of my clients poached me, and I moved on to becoming the head of treasury for a local group here in Dubai. What we managed was real estate, hospitality, and obviously listed equities. And that was a really interesting role. I got to mix with a lot of, big shots. You go into offices that you normally wouldn't go into. Bank CEOs come to meet you. So it was really like a different profile altogether. I felt very important. But it was also a very stressful job because I did that around 2018, 2019, when the Fed was raising rates the previous time around. And let me tell you, that wasn't fun for us at all. So I can appreciate, managing money a little bit, or being part of the CFO treasury team on the inside when the Fed is raising rates. And it taught me a lot again, so every experience you have teaches you a lot. So it's not just books, but it's also people you meet, things you listen to. I mean, I learned so much from you and the team all the time. So it's a little like that. And I think that's been my superpower always, to know who to learn from. So I try to find the best people in the business, in the game, to learn from. And soon after I left that job in 2019, I started up my own shop. It was okay because 2019 wasn't a great year. And things were like rolling off. It wasn't very great. I was trying to arrange loans, and so arrange debt and capital for companies. And it wasn't all that great. I had some successes, but a startup is never easy. I'm sure you know this better than me. And then I got a contract with a bank to set up their syndications desk. And that was a very, very interesting role as well. Because what I did was I bought and sold loans in the secondary market, including some distressed debt. So again, I now have an appreciation for how that side of the world works, where distressed debt is, we have plenty of it right now. So taught me a lot of things. last year I left all of that and I started working from home, and I decided to start up, two companies. One is Trader Aid and the other one is Macrovisor. And I have to tell you, Macrovisor is modeled a little bit like Hedgeye. Um, I think, we drew inspiration from everything that you guys do. And I think people need to understand the macro. People need to understand uh, the environment we are in. And it's not going to be the same as what we had for the last 15 years.
Yeah, that's a great life walk, just going through how you get to this point. And I do think, at least for me, the most valuable experience that I have is my experience itself. Making mistakes is actually quite critical to my success because I'm forced to, in this on this content platform, to fail fast, or I'll have many people telling me that I'm going to fail tomorrow and the day after that and after that and after that. But it's an interesting life walk that you can find, and if you can get into it and find a passion for it, I mean, the kind of work that you're doing is going to help a lot of people. So on that, like one and the behavioral component is critical. Like you said, your superpower is learning from other people, but also reading people. Like when you said, okay, and this is really my first question is, it's the difference between what that CFO wants to tell me and what I want to know. Where do you think we're at? Like if you want to talk about banks, publicly listed banks, where they're at, you want to talk about corporates, anywhere on that spectrum, because I think that the answer, what I wanted to know, and I said to Steph Pomboy, I said, I don't know how bad these earnings can get. Like she said, down 14 to start. I don't know, but I'm interested to get your perspective on that, on where the divide is between the two camps right now.
So I have earnings at down 13, actually. So not very far from Stephanie.
Oh, really? Okay, cool. So down 13 year over year for the S&P or for
yes.
this year?
For the S&P.
Yeah,
yes.
Okay.
So my target on the S&P is 3,200. I know we're a far cry from there, but I'm okay to be bearish on this show, right?
Yeah, I think you're in a safe spot. Yeah.
Okay, good to know. No, so look, I think so. I tweeted something a little while back where I said, it's not just investors who can be geniuses in a bull market; it's also CFOs. So will the real CFOs please stand up? Mm-hmm. So the truth is, I think even the CFOs have a very challenging time navigating this environment. I mean, if you think about it, 15 years ago, I was pretty young. I was 4 years into my career. And I'm guessing a lot of people who are finance managers, who are CFOs, are around my age now, right? So they would be, 5, 6 years into their career. So there's not a lot that you would have probably, or they would have remembered of times before the 2008 crisis, right? So this high interest rate environment, I don't think it's something that, it's not something people actually would remember, let's say, Mm-hmm. So I think navigating this, is going to be very difficult. It's not just that they don't want to tell us, but I think part of it also has to do with they don't know how bad it could really get. Mm. How many of these people, and I'm talking particularly about many of the younger ones, let's say, the unprofitable tech companies, and I'm not trying to single anyone out here, but the truth is all these guys are between 40 to 50 years old, and they probably didn't see what happened in 2000, 2001. And they wouldn't be studying it as much as you and I do, because this is our job. We study the markets, right? But these guys, they have day-to-day hectic schedules. So I kind of feel it's not just that they don't want to tell us, but I think that they're a little bit living in la la land. they just don't know how bad it might get, or they can't remember.
That is Steph and I were back and forth on that too. I mean, there's fraud, right? And then there's willful blindness. And then there's just ignorance. I mean, like ignorance can be in a polite way, just born out of a lack of experience or not having the ability to go through it on your own. That's a question for you though. Like how much time, just to give people a sense of, you said that's our job. How much time, first of all, do you put into a day just in terms of pure analytics? whether it be reading, modeling, or however you want to define it? How many hours in a day?
At least 12.
12. Okay. And you're
Yes.
building off a base pack of the experience that you gave us. So again, this is like a real, and generally speaking, this is where people find the twilight of their career analytically between kind of that, this isn't I don't want to say anything about people's age. People get triggered by anything. You said something about young people. I'll say something about old people. Guess what? When I'm old, like 80, I'm going to be like way worse than I am today because I'm already getting bad. But the 12 hours a day, and you're focusing purely on top-down macro at this point. You're not building company bottom-up models, correct?
I do.
Oh, you do?
I do build models. Yeah.
Like, but company build-up models or top-down macro models?
Both.
Both. Oh, okay, good.
Yeah.
So can you go through that, like your allocation of time on those on those two things? Because I have my, as you know, you're familiar with my analyst team. It sounds like they build all the bottom-up company models, and I work with my macro team, my 7-person macro team, modeling it top-down, and that's how we come together.
Right. So this is why I say that we're modeled a little bit like Hedgeye, because I'm trying to do a little bit of both. So
Okay.
a little bit of you and a little bit of your analyst team. And I love them, by the way. I learned so much from them as well. Well, me and my partner, we both look at the macro. So I have a little bit of help on that side, which is really good.
Yep.
He takes some of the load. I take some of the load. We divide up, what we're looking at, and we take it so on and so forth. But for the bottom up models, those are actually a lot more time intensive,
Yep.
honestly, because you have to read through transcripts, you have to read through 100 pages of 10Ks and so on. And there are so many companies, right? So we have economic indicators, but these are a little bit easier to track with what we have. But if you're looking at company models, you're not readily taking analyst estimates, right? So if you're building your own models, that actually takes more of your time. So I would say it's 70-30 for me. So 30% macro and 70% of, company models.
Yeah, I think that's, that should give people a healthy appreciation of the job if you're doing both. And there are a lot of different ways to do it. You can do it like I do it with a big team. You can do both. I think my analysts would say that they're like 90+%, and then maybe 10 on the industry, and they rely on me on the top down.
Yes.
But it really is. It must be. To me, it would be. I'd call it like a fractal pattern, something that's beautiful that appears when you have a macro view and you're doing all this work on a bottom-up, company, and all of a sudden you're like, boom, there it is. This is where I vary wildly versus what this company is saying.
So I love that you put it that way, because I was listening to a couple of people who were talking about volatility like you, who were talking about macro, who were talking about various parts of the market, right? And how they're trying to invest. That you have to know who's out there and what they're talking about as well. So, but what's interesting is all of these factors, whether it's the macro or whether it's, market making or however you want to see it, cycle investing, factor investing, or even just bottom up. I think if you have the right mindset and you know what you are or where you're headed towards, they all come together. And the confluence is so beautiful. And, it's just so very apparent. So it's like a marriage, right? It's like a beautiful marriage of various parts. And it's actually quite lovely. And you can get to it either from the bottom up or from the top down, as long as you're willing to keep an open mind and remember what's going on in the markets.
Yeah, that's very well put, and I love how you got to this point of your career to be able to say it that way and do it that way. You're doing that job, and I do find it, it's amusing in a sense that people have all these macro opinions without having a model at all. They just have a thought. They just have a feeling in some cases, or most importantly, they have a position. which is where most people's feelings and thoughts start with, their self-interest position. They want a certain outcome to become true. And that outcome being whether it's the Fed's outcome on some kind of a mild recession in the back half of the year, or no recession at all, a soft landing. A lot of people like that idea, but on the other side, they're all very quick to beg for the Fed to come help them if that's not the current outcome. So what do you think about that?
Well, the market tells you everything. I mean, it's all over the place, isn't it? It's like no one can make up their minds. One time they're asking for a pivot, the other time they're saying, oh, but if we have a pivot, then we're in the worst. I'm not sure we should be begging for a pivot, honestly, because I mean, you know this better than I do, that if the Fed decides to cut rates, it's only because something really, 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 really bad has happened. It's not a situation that we want to be in. And I think people underestimate the Fed at this point. The Fed can and will, hike into a recession if they need to. They've done it before. They have this conception, or they have this idea that they have the tools to correct things. So, over tightening is always something that they're willing to do. And I think, the Fed chair said something to that effect as well in his last conference call, or the one previous to that. He said something like, he's not afraid of over tightening anymore. At least that's the message I got. And if that's the case, we're in for some trouble. I mean, whether we actually cross the line into recession or not, we're going to go through a period of a very painfully low growth rate, right? And as you rightly point out, with inflation coming down, the growth rate coming down, we're in quad 4. You're quad 4. And we're staying there, I think, for a while. I know you have it for one more quarter, but do you feel like it might continue for longer than that?
Well, on that, it's it's a coin toss in the 2 quarters after that. I mean, if we always show, we don't get into the details because it'll put people to sleep every morning on the macro show. But this one slide that we talk about in the current macro deck, which is always slide number 19, we show the conditional probability or the conditional factoring of a quad outcome. And I just call the 3rd quarter or the back half of the year, for that matter, a coin toss. So, because what you're really talking about is what you just called out specifically. If you look at the year-over-year rate of change on GDP growth, it's below 1% in all 3 quarters from the 2nd quarter to the 4th quarter anyway. That's on slide 13, guys. And I think that would qualify, like with your opinion, that sub 1% growth or 0% growth is as low as growth gets, unless you've observed. And this was actually the lesson. My question on this is going to be back to how you model things. This was the lesson coming out of 2001 and into 2002. Was it like you could barely see the recession, right? Ayesha, you could probably see it because you have better vision than I do. Okay? But I got my hair's going gray. I got these glasses. I got 4 kids. I'm like a bear, and it's like sometimes I have a hard time. But you could barely see that recession in 2001. But you could really see that profit recession, and the profit recession, was what really, determined the ongoingness of the bear market. And by the way, this in so many different ways. I don't want to get into the mechanics of it, fully loaded with ODTE trading and all that. But the mechanics of bear markets that bounce are very similar from the 1999 growth bubble to going to an environment where GDP growth is extremely low, if not even recessionary, but the corporate profit cycle just won't go away. And that took you all the way into 2002 before, obviously, the stock market bottomed. So and you've written about margins, structural components to earnings quite a bit. Like, what do you think about that? You said down 13, but could you go to down 13, from down 13 to down 20 to down 25? Back then it was down 50.
Yes, I think it was somewhere, well, the average is, I think, somewhere around 30 or something, down 30. And to be fair, the down 13 is, I think, conservative. And what you're saying is absolutely right. I mean, if we have a situation where this profit recession is protracted, we're in for even more trouble. So we might have a shallow recession or a mild recession, as they're calling it. but it might be longer, which is exactly what we saw in 2001, as you're saying, right? And I was looking at these charts before I came on just to remind myself what happened. And that's exactly what happened there. So everybody seems to think that the market bottoms before we see a corporate profit recession, but that's not always the case. And that's exactly what didn't happen in 2000 and 2000 to 2002. And I think we're very much more like that right now. So the dot-com bubble, because though that bubble is very, very similar to what we're seeing here, like the equity bubble, and, we're throwing money at AI, we're throwing money at the metaverse, we're throwing money at, whatever new concept, comes up. And so that situation still hasn't gone. I mean, even today, I saw an upgrade for NVIDIA based on AI. I mean, I don't even know what that means.
It just means it's AI. You don't get it, Ayesha. It's just AI.
Look,
It's like Michael Saylor used to tell me at 68,000 Bitcoin. You just got to believe, man. That's what he told me. So the AI,
look,
you don't have to do any work. You just got to say AI, like Dan Ives, like that with an I, and you're good.
So look, it's either intelligence or it's artificial, but it can be both together, right? So
That's funny.
so we've got this situation and it's still going on. So I kind of feel that people still don't get it. And last night we got reports from JB Hunt, and I'm sure Jay Van Sciver would have, spoken about. I didn't watch the call today. I'm sorry, but I'm sure he would have spoken about this morning. And the CEO was talking about a freight recession, and he's talking about volumes going down. He's talking about freight rates going down. So you have volumes going down, you have rates going down, so you have everything going down. So yeah, perhaps we aren't seeing exactly, GDP going down as such, but we're seeing the ISM numbers going down, and that's in recessionary territory. We're seeing profits going down in recessionary territory. We're seeing margins going down. You name it, everything is going down, and I don't see how we're still happy about this situation. Yesterday, I put out a tweet about the Russell 2000. I mean, it's been so strong in the last couple of weeks. And I said, what are they so happy about? When there's a recession, the average downturn is about 26% on the Russell 2000. So I don't see what people are seeing right now. And it's kind of like we're still being led by, the tech growth. I think what people believe is because these guys have already cut costs. It's become the year of efficiency, right? So we're looking at something called the year of efficiency. And I don't know why they suddenly decide to become efficient. These guys have been, spending like drunken sailors for the last, 10, 15 years. And then suddenly they realize, oh, but hey, we need to be efficient now, right?
Yeah.
You should have, being efficient was your job. It should have been your job. It should have been your job for the last 5 years, 10 years, whatever. Not you wake up one morning and say, hey, I'm going to be efficient. Okay, so what's your idea of being efficient? Cutting costs. Okay, what costs are you cutting? I'm cutting people. Which people are you cutting? So either these are people you hired and you don't need, or you're cutting people who you do need, and therefore you're going to be in trouble for the next 5 years, right? Because you're cutting essential people. So either way, they're doing this thing wrong. And we're in a situation where these guys now think that, okay, because they've cut costs, we're going to see fabulous earnings, right? Because margins are going to be beautiful, costs are down. But the problem is, it's not just about costs. It's also about the top line. And we have demand coming down. Don't we have to factor for this? Don't we have to factor for the fact that small businesses are suddenly going to turn off the switch on Microsoft or on AWS or on a number of other companies? I mean, are you going to buy a new phone right now? I know I'm not going to. I probably won't replace my laptop. I probably won't replace anything that I have. I have an old car. I'm not going to replace my car. I mean, it's not the time for any of this.
No, you're right.
So it's not just the bottom line that matters. It's also the top line, and we need to remember that.
Well, I mean, the top line is what gave birth to the mother of all bubbles. I mean, it's at a bare minimum, it's intellectually dishonest to say it any other way. I mean, by definition, when you're in quad two and the rate of change of revenue growth and profit growth is accelerating at the same time, that defines multiple expansion, that defines bubbles. If we didn't know that, we wouldn't have been long the bubble in 2000 and going into 2021 and stayed with it. So the other side of that, it just doesn't get people paid, I guess. And I think the biggest thing, though, is that they look at their screen. This is very similar to 2001, in April of 01 in particular, where people look at their screen and they're like, well, JB Hunt's not down that much today. It must be priced in. So,
yes.
What do you think about that? And let's get into that too, if you want to enjoin our friends at the 0 days to expiration bubble.
Yeah, so I mean, this is something that everybody keeps saying on Twitter. Everything's priced in. And I asked this really snarky, silly question on Twitter the other day, saying that, so if everything's priced in, then why does the market move? I mean, seriously.
Yeah, okay.
You would be a trillionaire, I would be a trillionaire. We'd all know everything, right? So, I mean, I don't know what people are thinking. So I kind of feel that people say this just to sort of, support their own narrative. Yeah. And it's all about that, right? So it's all about the narrative, the story. So people don't like us because they call, we're too bearish or we're perma bearish. But no, we're not. We're looking at the data, and the data is telling us something, and that's all we're talking about. We're not really being bearish because it's fun to be bearish or it's cool to be bearish. I mean,
it's not cool.
If anything, it's not.
It's definitely not cool.
And shorting is not easy.
No.
So it's a very, very tough game. It's easier to always buy and hold.
Well, I mean, and you wrote this as well. I mean, like you said, many analysts haven't seen this part of the cycle, so that's an experience point. Well, many analysts don't trade the cycle. The portfolio manager does. And many portfolio managers clearly, if they did trade the last two bear markets or recessions going back 25 years, they're not really well known as doing that well. And if they were, we'd have them on Hedgeye TV, we'd show their returns, but they're not. So, my personal opinion is the precise reason why they're not is that they would read JB Hunt today or JP Morgan on Friday. JB Hunt doesn't go down enough, or look at JP Morgan, it's going up, it's not going down. They have a recency bias. They don't see the cycle. They can't see past their nose. They trade yesterday, not tomorrow. As Stan Druckenmiller would say, you're an idiot if you don't trade tomorrow. What are you doing trading yesterday? I mean, that's only if you're a trader. But on the short-term trading dynamics, I mean, I trade, right? Like, I got a problem.
Yes.
I trade. People would say and people try to reduce me to being whatever they want me to be because I trade. Oh geez. Well, you just bought and hodled a 70% decline in Bitcoin. You're much more, from a morality perspective, a better person. But for those of us that do trade our positions or risk manage them is probably a more appropriate way to think about it. I've never seen anything remotely as large or as frequent and short duration as these 0 days to expiration options. They absolutely have impact in the market. Yesterday they did, for example, on the line that the S&P 500, I think the 413 line, like 577,000 calls traded. So what say you about this? The rigging of it, or just the short-term nature of it that can change what you see about the actual gravity of the cycle itself.
So it's interesting you bring this up because I was just having a conversation with my partner before this, and he's really good with options. So he understands this market very well. So what he was trying to say is that, these guys are actually selling put premium to buy calls, right? Mm-hmm. So that's how they're funding their calls. That's the mechanism going on here. And my thought to this was, I think they're trying to bid up the market for exit liquidity. I think a lot of these portfolio managers, as you rightly pointed out, were caught off guard last year. They knew it was going down. They just didn't know how much. And I think the market went down far more than they expected it to. Mm-hmm. So they're sitting on a bunch of losses, bag holders, as people call them, right?
I
And
would never call somebody that.
well, I'm a bag holder on one or two stocks. It's okay.
I love that term, bag holder. It's just, you're just holding the bags. Yeah, so keep going.
Depends on what kind of bag.
Yeah,
I
yeah,
mean, it
true.
could be a regular bag. It could be a very fancy Louis Vuitton. But so,
Last night I had
but
a bag of cupcakes because it was my wife's birthday. So I went to
oh,
the cupcake shop because I have 4 kids. They like to eat the sweet stuff, and I had 2 big bags, large bags. I was holding the bags.
Laura, right? So please wish her a happy birthday.
Oh, thank you. You're too
Um,
good.
yes. So I think the issue with these are exit liquidity. And I think people need to understand this concept of exit liquidity. These
Ah,
guys are building things up so that, at some point they can get out. That's why when you see the market fall, and you trade, I trade as well. I'm guilty of that as well. But when you see these days, the red days, you see how they go down. They go down relentlessly, right? And my theory, and I could be totally wrong here, but my theory is they get it to a level where, they just want to exit and then they're selling on.
yep.
And these are not just, portfolio managers, but these are also company people. So you see that there's been a lot of selling where, the company executives have been doing a lot of selling as well. So I think all of this is taking all of us for a ride. And when I say all of us, I mean retail. And we need to understand this a little bit. The market is, playing us for a fool.
Now that is, I like that. I mean, this is why we do the investing summit, for someone to have the spine and the process to lead them to saying something like that. This is all about you, the retail investor, becoming the bag holder. We want our bags, our corporate bags,
Yes.
to be held by you who wouldn't know otherwise. And that's like, and you called it exit liquidity, right? So, and just let me get this correct one more time to repeat what you said. You're selling put premium to buy bid up calls, and then you're going to take that higher price and exit the cash liquidity, like the cash equity positions.
Yes.
Right?
Yes.
Okay, that's pretty straightforward. I mean, and people every day, they bang their head now against the wall trying to say, and it's a typical, I see this almost as more of a rookie mistake or somebody who's never risk managed, market, particularly in what I call the chop bucket when the VIX is in the high teens into the high 20s, which is where they have been able to keep it, which keeps you kind of like in a back and forth market, not one that's collapsing like the one did in phase 1 of the bear market, which is from January to June of last year. There are, of course, 3 phases to a bear market, according to me. I like to say that. My friend the other day said, "Are you citing yourself?" I said, "Yeah." But that people are like, "Why? Why is the VIX at 17? Or why was it at 18 multiple times?" And I'd always say it remains undefeated. Well, it doesn't matter if it's at 17 or 18. It's still the same point. Is that you're suppressing vol to achieve your liquidity goals. Now,
Yes.
wouldn't Jamie Dimon quite like something like that for the entire banking system?
I'm sure.
Right? I mean,
Yeah.
on one hand, he's saying before the crisis that there are some real issues in the economy. Then in the crisis, it's like, wow, this isn't over. Then on his conference call, now that he's got everyone's bags, all the money, well, for us, it's pretty good. We're going to get all of our managing directors to have to come back to work every day now because we have a lot of money. But I'm not going to talk too much on this conference call about who's holding the bag.
Look, there's a reason that he's Jamie Dimon and he leads the biggest bank in the world. And Secretary Yellen gives them a call when they're in trouble.
It's nuts. I mean, do you think? Well, first of all, I think you will be, and I will be, because I'm agreeing with you. We'll be called conspiracy theorists for talking about this. What do you think about that?
Yeah, it's okay. We'll conspire.
We'll
conspire to be bears together. Yeah,
it's fine. Well, the thing about conspiracies is that they happen. But this question of have you and your partner talked about like we know that there are three major options dealers. There are more than that, of course, but three big players in the market that are active as the day is long. One is on both sides, of the trade. One could argue, and one can really see, what all his portfolio managers are doing on that other side of the trade. What do you think about that?
Look, they're making money in between, right? So what do they care?
They don't.
I mean, if you are a middleman, if you're a broker, do you care?
I think
you're taking fees on one side, you're taking fees on the other, you're happy.
Yeah. If you and I were brokers, we wouldn't care. That's the job, right? And
you can't blame them or fault them for it, right? They're making money legitimately. This is the fun part of these zero DTEs. They're totally legal.
Yeah. Well, I mean, that's the point with these 0 days to expiration. You don't even have to post margin. I mean, they created a system that they can. I mean, this is as old as Ray Dalio himself. I mean, he created the tips market. It's not like he didn't go to Larry and say, "Hey, dude, I'd like to have a more flush market here because when duration isn't working, I got to park the capital somewhere so I can beat everybody else." This has been going on for a long, long time. But I do get a sense that anytime someone like us talks about this, particularly tweets about it, they're like, "Oh, that's because you're bearish. You're going there because you're bearish." No. It's happening. It happens every single day. It's happening at an accelerating rate, is it not?
It is. And let me tell you something. It's not you and me being bearish, Keith. The market is actually bearish. The data is bearish. We're just reading the data. So it's not as you said, it's not a feeling. We're not translating our feelings to the market or to the people. We're just reading the data and analyzing it and interpreting it as we see best. This is my view on the data I'm seeing.
I love that. That's great. Now, I have to love asking some of these questions. By the way, I got two into our conversation, so I didn't leave enough time. But if you don't mind, I'm going to ask some of the questions. This is Bill from Connecticut. Actually, the highest voted question is it's about what we're talking about. I've seen your Ayesha. I've seen your comments that the new way to game the market is through ODTE. Keith's been talking about this a lot, and he said, "Can you elaborate?" I mean, I don't know what else. Is there anything else that you want to say on that topic?
No, not really. I mean, the only thing I don't know. I mean, I really like to see this stop because it is sort of distorting the market, right? And I don't know when it will.
I mean, it's kind of like, I mean, it's in a different way, In 1987, if we were having this conversation, you had a very hot start to the year. Like S&P, I think this year was up almost the same in January as it was in 1987. Same economic conditions, anyone could see them. And then, of course, the market had an abrupt collapse that nobody could see coming. And there was portfolio insurance to blame. Now we have, and I'm not saying it's the same, but I'm saying it's the same in the sense that you have the same economic conditions, post-cycle peak, slowing, liquidity becomes a problem. So, I mean, would you be entirely surprised if the S&P 500 was limit down any day between tomorrow and the end of June or this year, where it's limit down, where the S&P 500 goes down 15 to 20% like a hot knife through butter?
I wouldn't be. And, I know we're not supposed to talk about our feelings, but all of this happening actually does give me a very ominous feeling, And it's exactly, and now that you mention it, 1987, it does feel a little bit like that, or let's say it's a repeat of that, right? So I won't be surprised. I mean, it's always been like this. When we go overboard with something, we tend to see negative consequences.
Mm-hmm. Yeah, that's I don't know if you have read this book by Roy Sabag, but I was citing it this morning in the early look, and he's a Canadian guy. He's very similar to you in the sense that he's a practitioner, but an ongoing student of this relationship between economies and markets. But his basic relationship that he always comes back to in trying to explain the natural order of this is fractal in nature. You know, you have energy, you have the two components of thermodynamics. You have energy and you have entropy. So how could you have all this energy, fully loaded from everything from YOLO call option buying to 12% GDP to as much money as you could print, and not get the entropy?
Yes, and that's beautifully said, by the way. Entropy is such an amazing concept, right, in physics. You can see I have a lot of books behind me. So, but and one factor of entropy is that once we, go through, it's like breaking an egg. So once you break an egg, you can't put it back together again, right? So
Right.
there's no going back. So it's nice that you bring up the word entropy here. And I think, we have distorted the market to the point where there's no going back from this. So I think that's a very nice way of putting it.
Well, if there's no going back, I mean, there really is, I guess, just to bring this full circle, there really is nothing left other than what you started with, which is the difference between what you want to tell me and what I want to know. Like, when does the egg break? The amount of times I get asked this question, I mean, I'm a lot of things, but I'm not idiotic enough to tell you what date. But I think we're saying that we know what the answer is, we just don't know the day that it's going, or the week. Am I summarizing that correctly in terms of how you think about it?
You're right. So the eggs will break. We just don't know when.
Yeah, it's that's it. That's all we needed to know. So from Mama Bear to cracking the eggs, I appreciate having my first opportunity to have a real conversation with you. It's humbling to have you compliment us. And again, we didn't ask you to come on to do that. You just incidentally did it, and I take that with great pride, like our team does too. So on behalf of my team, thank you, and I'll look forward to meeting you in person and talking to you again soon.
Thank you so much. It was such a thrill to be on. I hope you can visit Dubai sometime. That would be nice.
I've never been, but it sounds like I just got invited, so I appreciate that.
Definitely.
Thank you. I've never been to the Middle East. I've cracked some eggs. A lot of components to this. Up next, this guy understands the relationship between the energy and the entropy. Ben Hunt.